All right, thanks everyone for being here and joining us for another free webinar brought to you by optionslam.com. Let's get through the legalities quickly here. CFTC rule, please read and understand it before you risk your hard-earned money in the markets. Please read and understand the CFTC rule. By attending these webinars, you hereby agree to our disclaimer, which tells you that we are not licensed financial advisors. We're not registered investment advisors. We do not provide investment nor financial advice, nor do we make investment recommendations. These webinars are for informational and educational purposes only. You shall be fully responsible for any investment decisions that you make, and such decisions will be based solely on your evaluation of your financial circumstances, investment objectives, risk tolerance, and liquidity needs. I am Marco, and this is my email address, optionslam.com@gmail.com. Please feel free to reach out with any comments, questions, or suggestions. I will answer your emails personally and promptly. Michael types in to the chat box. Let me read this out here. Given the mixed recent news surrounding Tesla, that's funny. There's always mixed news surrounding Tesla, isn't there? Better than expected vehicle deliveries, but delays in the rollout of robo-taxis. Oh yeah, I've been in some Tesla trades lately. Believe me, I'm familiar. Can we deconstruct a technical analysis-based trading strategy as the stock at a critical crossroad? Okay. Can we analyze key technical indicators, moving averages, RSI, MACD, chart patterns, support and resistance levels, candlestick patterns, and trading volume, then decide on option strategies, bullish, bearish, or neutral, and risk management techniques, stop loss orders, position sizing? Can we discuss this in detail during our strategy session? Probably not. Thanks, Michael, for your suggestion. I don't think we have time to do all that, not today on this short of notice. And if we wait until next week, we're probably too late. Isn't Tesla reporting this week? Let's see, let's go in here and see. TSLA over at optionslam.com. Just type your symbol in that top corner and you find out that they are reporting, in fact, tomorrow after the close. So tomorrow after the close. And no, I've got too much on my plate, Michael. I'm sorry I can't take you up on that, but sounds great, sounds interesting. Please shoot me an email, optionslam.com@gmail.com, with all of your suggestions and ideas. And especially suggestions for webinar topics. I apologize, Michael, we're not going to be able to do that today. Let me get on with what I do have planned. In the heat of earnings season, we try to provide webinars weekly, okay? Rather than the normal schedule, which is every other week. Oftentimes, webinars are on Tuesdays at noon during market hours. Sometimes there's a conflict in my schedule, and then the webinars are on Mondays. As we are here today, the main focus is on through the earnings trades. This is as opposed to pre-earnings strategies, okay? The main focus of these during the heat of earnings season, which is about, I'm going to call it 3 weeks long. Although there are earnings every week of the year, 52 weeks of the year, there are earnings that come out on stocks, okay? So it's not like there's only earnings for 3 weeks and then there's no earnings. No, not at all. It's just that there's about a 3-week period, maybe you might even call it approximately the duration of overall of about 30 days, in which the great majority of companies report their earnings. And then the next 2 months is kind of, slows off and tapers off, and then right away you're back at another quarter. So it's a revolving door type of an opportunity to trade earnings. Pre-earnings strategies is different than a through the earnings trade, and a through the earnings trade is different also as compared to post-earnings strategies. Through the earnings release trades are put on immediately before the earnings release event and generally close shortly thereafter. Sometimes as short a time as the open immediately following the earnings release. So you put the trade on your stock. For example, with Tesla, you would put the trade on immediately before the earnings. They're going to report tomorrow after the close. So you would put your trade on, whatever strategy you've decided on, right before the earnings is released, right before the close. Obviously, you can't put a trade on options after the market's close. You have to do it before the close tomorrow, and then right after the close, they're going to report. Then you can't manage your earnings strategy with options. You can't trade options after hours. Now you can trade stock after hours. There are some after hours availability for trading stock, but not options. But the next morning at 9:30 Eastern time, you can then begin to manage your trade. Or you can close that trade right at the open the next morning, or within a few hours, or by the end of that day. The very first day, 1-day trade, implied volatility crushes overnight. Oftentimes our through the earnings strategies take advantage of implied volatility crush, and which is a wonderful thing. And some traders will hold their trade, especially if it's going well, right? Hold that trade until those options expire. Whether that be that Friday, in this case, it's going to be this coming Friday, which is July 26th. The front week weeklies expire on July 26th, or you might have chosen to use monthly contracts, and then those expire on the third Friday of the month. Now, before we get into the topic of through the earnings strategies and some of the emails that came in with stocks, I want to reiterate that my personal go-to strategy is the double eagle. And we just had a workshop recently, and it's finished, and I don't know when we're going to have another workshop. It may be this fall, or it may be next March and April, God willing, that I'm able to provide such an opportunity. But some traders have approached me, and I have agreed to sell the recordings of the last workshop. And I've just got several traders who have just completed. I've got a couple who are still taking in the sessions because it's a long workshop. Anyway, let me get through this very quickly. There's an opportunity to take the workshop via the recordings, okay? You can go into to learn a little bit more about it, go to the optionslam.com archives, the webinar archives found under the resources tab, and see some of these webinars, okay? Implied volatility build versus IV crush trades, March 4th, 2024, okay? IV build, IV must first build before it can crush, September 5th, 2023, okay? Or go see Marco's Double Eagle Strategy Revealed, February 23rd, 2023. And there are others. If you do not have access to Option Slam archived webinars, no problem. Go to doubleeagleworkshop.com, all one word, doubleeagleworkshop.com, and click the home page and scroll down to the video there. I'll just show you quickly. You go to doubleeagleworkshop.com. Okay, it says register now to receive. So we're not advertising this. This is a very closely held offer only for Option Slam people. I am personally hand-holding anyone who takes me up on this offer via email and personal one-on-one webinar sessions, tutoring people to learn how to trade the Double Eagle and become part of our private community. You go here to this website, doubleeagleworkshop.com, scroll down and click on this video right here, okay? So that is available to the public. You don't even need to be an OptionSlam.com. This is a separate company owned by me, solely by myself, and it is focused only on this strategy. There were 8 sessions in the last workshop, okay, for a total of 30 hours. Most sessions lasted 3 to 4 hours. Some of them went a little over. But you can take it at your own pace, at your own speed. We did them 1 session per week. So we have monthly meetup sessions for all our Double Eagle traders. We have a community of traders. We have a private Discord channel where we share trade entries, ideas. We boast about our profits. By the way, we've just had several 100+% profit trades in the last few weeks, and many 70%, 60%, 48%, all it. Yeah, and then we can go to the Discord channel, boast about our profits, or we cry about our misfortunes. We have losing trades too. You cannot be a trader with no matter what strategy you have without having losing trades too. Fortunately, we don't have that many losers. We have a lot of winners and a lot of huge winners. But anyway, go to doubleeagleworkshop.com to learn more about it. Okay, having said all of that, I wanted to get that offer out to you. It is a limited time, and if you wait for the next workshop, which may come this fall, and it may not be, it may not happen until next spring. In either case, it's going to cost you more money than taking me up on this offer now, because we will be raising the price. That I can promise you. Okay? All right. I apologize. I don't normally sell things at these webinars. These webinars are for educational purposes only, but you know, this is an opportunity that I would like to make available to my Option Slam folks out there. All right, let's see if we can get on with. Okay, so as of Friday. Okay, so this is from Bruce. Thank you very much, Bruce. Bruce has emailed several times in the past with ideas. Bruce likes to sell naked puts, okay? And so here's some excerpts from his email. As of Friday's close, spot was at 295. According to Option Slam, the implied volatility is this and that, 10.93 for the weeklies, 13.06 for the monthlies. Okay, now I could have sold the 240 puts for $1.09. They're about $1.03 right now, the last I looked. There's an 18.8% downside protection. In other words, so the 240 from where the stock was trading at the time Bruce wrote this, the 240 strike was down almost 19% below where the stock is trading now. 19% of the 295 takes you down to the 240 puts. And the implied move now, and let me just make you a quick correction here. What we publish at OptionSlam.com is the implied move. The implied move is derived from implied volatility, because implied volatility is a factor taken into consideration in the creation of, or in the to derive options premium for any given contract. Okay, so implied move is based on the all it really is the price of the at the money straddle. And which suggests how much the market is pricing in what the market thinks the stock is likely to do. Some websites call it the expected move. Okay, we call it the implied move because I just prefer that terminology. So anyway, let's get back to this. This is the kind of disparity that I look for. So that's great. I love this. This is really good. Let's look at this quickly. Let's just go right. Let's jump over here to one of my trading platforms. I like to use this one for teaching purposes because I love the Analyze software that comes at Thinkorswim. Now, if you don't have access to Thinkorswim has recently become available in some countries where it wasn't available before. Just within the last few months, it has become available in the UK, for example. I don't know about Canada, but some other countries it's become available where it wasn't available before. Now, if you don't have access to Thinkorswim to get this free with an account analyzer, then you can get Analyze software elsewhere. You'd have to pay for it. Option Strat is a company that I think that's about $25 a month. I could be wrong. And then Option Net Explorer, One, ONE for short, is another one. I think that one's around $88 a month right now. But I think it's critically important that you have options analysis software at your access, okay? All right, so let's see. Let's go here. We're at spot. We're in the options chain. I just use the Analyze tab because the Analyze tab allows you to add simulated trades. I can go to the Trade tab and I can get the exact same options, the exact same information here at the Trade tab, and I can design a trade in the Analyze tab, and I can actually place my order from the Analyze tab. So personally, I don't see any purpose to going to the Trade tab. I just use the Analyze tab, and if I'm going to place a trade, I just place it right from there. So anyway, let's see, the front week weeklies, is that what, according to the option, yeah, that's what Bruce was looking at. So let's take a look at the 240s. Okay, so the price must have gone up. No, 292.27 is where the price is now, and Bruce was looking at 295.70, and unless he was looking at the let's see, maybe he's looking at the monthlies. Let's go out to the monthlies and see what those are. Those would be, let's see, July 26th. So it's got to be the August monthlies. That's got to be where the 13% is. And the 240s there are, no, those are, I think we've just got a little bit of IV crush going on already, even before the earnings. It looks like the IV must have come down because the 240s are now trading at only about 80 cents. Only at about 80 cents now, with the price at 293. So are you seeing the same thing I'm seeing, Bruce? I don't know if Bruce is even here, but anyway, that's what I'm seeing. The front week weeklies have come down. So even though the price has come down, you wouldn't think that the price of the puts would have come down that much just with the weekend theta decay. Anyway, let's take a look. So here we are at that options chain. I'm going to take this down to, let's see, is 14 enough? No, that's not enough strikes. I got to take it back to that 30 I had up there. All right, so I have no problem with you with that concept sorry, here, 240s right here. Okay. Okay. I have no problem with these, that concept selling far out of the money. So in other words, the implied move right now, as Bruce mentioned, is about 10, about 11%, 10.93, he says in his email. Let's go over to optionslam.com a quick minute, which is right here, and we'll go to Spot, which is Spotify. Okay. Confirmed for tomorrow before the open. So this is a today trade. Today is the last chance to get into an option, option strategy on this particular stock. I need to log in here. That only takes a quick second here. Okay. And then now I've got all my data. Once I'm logged in, now I can see all the history. Let me change this to only show 10. So some of these, a lot of the stuff is customizable. Okay, a lot of the stuff is customizable for you. Anyway, at our site. Let's see what the stock usually does. Let's get familiar with the stock. I haven't traded the stock in a minute. I kind of like that saying, in a minute. All right. So what's the stock been doing? 17.28% max move last earnings event. So the closing move was 11%. This is the earnings history page, and there's all these other pages that are all specific to the stock. But let's just get a feel for what the stock's been doing. Well, it's been going up after earnings. The February 6th, it went up. The October 24th, it went up 10% by the close of the one-day close, the one trading day. Now, the earnings before that, it went down pretty heavy. So this stock is a mover. Look at these one-day moves: 14%, 10%, 11%. 5% is the lowest move, the smallest move I see on this page. Right now, there are three pages. There are more pages, but the more pages we go further back in time, and I believe those are less relevant. This is EVR, is the earnings volatility rating, which is something we've created here at optionslam.com, where we rate every stock on how volatile it is. And if you look, each one of these bullets, each one of these dots, points is an earnings event. As you can see, Spotify has been on the rise. The EVR has started out here back in October of 2019 at 2.6, and it has been on the rise until now it is at 4.7. So this stock continues to get more and more volatile. Be careful selling naked strategies. Selling naked puts could come to haunt you. Okay, especially on a stock that's this volatile. Now, here, what's the advantage to selling a naked option? Is that options are derived, as I mentioned earlier, from implied volatility. So the higher the implied volatility, the higher the option premium. So you're going to get paid well to take on the risk. Okay. As opposed to a stock that has a low EVR, think of it. If it has a low EVR, that means it's not going to have very high implied volatility. That means the options are going to be relatively cheap. So think about let me put it this way. You got a $100 stock with high implied volatility. And you got another stock that's also trading at $100, and it has low implied volatility. Guess what? The options premium for stock A with high implied volatility is going to be much more expensive than the option premium on stock B that has low implied volatility. It's that simple. It's just that simple. So if you are going to trade and sell naked puts on a stock that has a high EVR of 4.7, EVR is a 4.7, is a pretty high EVR, you're going to get paid handsomely to take on that risk. But What Bruce likes to do is go beyond the implied move. Okay, the stock market is implying a move of, see this 10.93% that Bruce mentioned in his email, and 13.06 that he mentioned in his email about the monthlies. Okay, now these numbers will change every day. This will be different tomorrow than it is today. These are 1 day delay. This is the previous day's closing implied vols, implied moves. Okay, if you want to get the accurate today implied move, it's not going to be much different. You just go to your brokerage and look at that at the money straddle for the current implied move. It's that simple. Okay. All right. Now, if you go the 10.9%, we're going to call it 11%. And let me just do it this way. I'm going to go 292.50. Let's see if I go calculator. 292 times, I'm just going to round it to 11%. Do I have a percent button here? Yes, is $32. So the implied move is $32. So if I take 292 minus $30, 292, because the market is pricing in a move that could be around $32. Okay, I just did the math for you. So if I take 292, and I can do math in my head, but not while I'm talking. Minus 32 equals 260. So the 260 is the implied move. So that's the implied move away. Bruce wants to know, is there a better strategy? Well, I don't know if it's a better strategy, but I got another strategy idea for you to take into consideration. I'm going to go down to the 260, and instead of selling that option, okay, instead of selling that option, I'm going to buy that option. I'm going to buy that put, but now what I'm going to do is I'm going to go to the next strike out, and I'm going to, holding my control key down, I'm going to sell the next strike down 2 times. So I've got a component built into this strategy that's designed around the implied move, okay? And it's going to give me protection beyond the 255 strike by $1.44 credit. It has a naked option component in it, and you can adjust the strikes to your liking, but I like to design my strategy around the implied move. So let's take a look at risk profile, what this looks like. I have to blow this up so you can see what this is called the name of this strategy is a front ratio, or it's a reverse back ratio, or it's a, what else is it called? I can't think of the other names that it's called, but let's see. Let's take a look at this. So the stock is currently trading up here. Let's see, find the live price slice. No, not that one. Let me delete that slice so I don't get confused, and let me unlock that one. There's the live price slice right there. So the price is trading way up here. Now, where do these options expire? These options expire the front week, so that's going to be this Friday. And I'm going to move my analysis software to Saturday because let's see, July 26th, okay, and July 27th. Okay, there we go. So let me just skinny this up. Okay, so the shaded area is representing 1 standard deviation. Here's where the stock is trading. 1 standard deviation is calculated to be down here to the 273. The implied move that we just calculated of $32 is all the way down here to the 260. Okay, and now that's 11%. And remember, don't forget now, we've been warned, because we took into account this information of what the stock has been doing lately. And it moves 11% often. It moves 11% often. It occasionally can move down. Now, the biggest move I see on here is this 14. So I might want to adjust my strategy. Let's do this. Let's adjust the strategy to take into consideration with the option slam information that we have here, the worst case scenario, 1-day move. Now, there's other pages that we might want to take a look at. And that is, let me jump over to the post earnings page before we adjust our strikes. When this stock went down 14% in 1 day, what happened by the end of that week? Well, then it was only down, guess what? By the end of the week, it was only down 11, just about 12%, okay? About 12%. Now, it did fall back to down 14% and even a little bit worse, but that took a month. If we're looking at the front week weeklies, those are far and away already expired by the time you get this far out in time. Okay, we're only looking at 4 days of trading left with the front week weeklies. Any other big moves down? Yes, here's a move down 13 that went down to 14. It started out with a, let's see, the percent 5 point. Okay, and then so there are some big moves, okay, to the downside. So I personally, I'm not comfortable with these strikes with that additional information. So let's just let's adjust this and let's see. Now here's the thing: when you do this, you buy one, and you. So what do we have here? Let's break this strategy down. What we have here is a bear put vertical. We are, and let me show it to you. It's hidden inside of here. It is buy one, sell one, further out of the money. Buy the 260, sell the 255. That would be a bearish vertical looking for price to fall, and therefore that's why this particular trade has this bump up and takes the potential for profit if it falls inside of this window. Let me just identify that window with a couple of price slices. Anywhere between here and here is an additional profit over and above the $148 credit. And that profit could skyrocket to a very high number of about $650, okay, at the peak, at the strike. Okay, we got a lot to talk about, so I need to move on with this. Let me just adjust this down to I'm going to adjust this down to 14%. Let me do it a different way. I'm going to take this down to 14%. Let's see, I got 292 minus 14% takes me down to the 251 strike. So I'm going to take, now what I'm going to do is I'm going to take my my shorts and I'm going to put them at 14% down from where price is right now. So that's the 251. Well, there is no 251 strike, so I'm going to take my shorts down to the 250 strike, but that doesn't leave me with much of a credit, only 27 cents. And I'm not willing to take on all this risk to only make 27 cents. So I'm going to also lower my put strike, the one I'm buying, down to the 255. Now I'm bringing in $1.06. Okay, this is a very similar amount of money as what you were looking to bring in. The alternative trade that Bruce brought to the table was, let me just put that up there for comparison purposes because it is a very similar amount of money to bring in as a credit, and that was the 240 strike, sell the 240 strike, and he was getting $1.09 for it, but it's not going that high anymore. These premiums have crushed since last Friday. I'm afraid these premiums have crushed. They're going to crush more. They're going to crush more tomorrow. I guarantee you that. But let's see. Well, let's just put it on there anyway, and let's say that you were able to get the ask for that or close to it. Let's say 80 cents for that. All right, so that's that trade. So let's look at that trade. So with this trade, this is just selling a naked put. This is what Bruce brought to the table. This is what he's done. He's got a lot of experience doing this. And my first caution is be careful. Spotify is a little bit dangerous to be selling anything naked on because it can run, as you saw in the Option Slam post earnings page, it can run occasionally. I guess only one time in the last 10 events did it run to the negative side to the tune of down 24% in less than 2 weeks. Okay, in 13 calendar days. Notice these are calendar days, not trading days. On this particular page, we do things differently on different pages for a reason. I won't get into all the explanations, but oftentimes 12, 14% is going to be, guess what? In my potential idea, that 14% is going to be right at the peak of profit. That's right where we designed the strategy right here, this 255, 250 front ratio, so that if the stock does go down 14%, like it's done a couple times before, that's where we get the most profit. Then there is a naked component. You got that bear debit spread built in here, long one, short one, but then you've got an extra one short, which is the short naked 250. Okay, so that opposed to this, I don't know, to each his own, but I prefer the back ratio over just a single put. So that's a very great. Thanks for bringing that to the table. Let me go back to this and let's see. However, I occasionally been wrong and I've been burned, especially when selling naked puts on high-priced stocks like Spotify, and especially on high-priced stocks that have high EVRs, EVR rating at optionslam.com, meaning that a 4.7% EVR, 4.7 point EVR means that this stock can move on earnings events. Is there a better strategy than just selling naked puts? And I think the back ratio or the reverse back ratio is better in my opinion, because it's especially the way I do it. I design it around the implied move. UPS, GE, and DHR look like good candidates for selling naked puts, and in my opinion, if they are good candidates for selling naked puts, they may also be a good candidate for entering into a front ratio trade. Okay, these are not, I made that correction already. These are not implied volatilities. Instead, these are implied moves. This is the implied move. We like to, implied volatility is kind of a esoteric type of a term almost, isn't it? But whereas if I revert to implied move, now I'm talking about dollars and cents. How far, how many dollars and how many pennies can this stock actually move from where it's trading today? All right. All right. So let's see. Are there better strategies? Well, there's all kinds of strategies, right? And these are risk profiles of a variety of strategies. And this is the front ratio. This is the front ratio that I just illustrated, but I did it with the put side instead of the call side. Okay. I did it with the put side. Is there one of those on here? I don't see one, but any of these trades can be, reversed to be used with if it's all calls, you reverse it to all puts. So lots of So these are the most popular, most commonly traded risk profiles that you see us and many traders talking about. Okay, now some traders also send in requests to look at the following stocks: Tesla, Google, CMG, but did not provide a bias on those symbols. So I don't know if those traders are bullish or bearish on these stocks, and therefore I'm going to have a little bit of a hard time helping you design strategy that meets your expectations. So when you send in stocks for us to review in these webinars, please send in your bias. Are you bullish? Are you bearish? Do you expect the move? And more information would be even better. Like we talked about the webinar last week, I said just to send in your bias isn't really enough. You need to give me, or at least you need to decide before you can design your strategy, you need to decide, how bullish am I? Do I think the stock is going to the moon? Or do I think it's just only very modestly bullish, or am I only very modestly bearish? And also, one last thing you need to take into consideration before you can really design an option strategy is, how long do you want to give the stock to do what you think it's going to do? If you think it's going to go to the moon, like I said, well, is it going to do that all in one day, or is it going to take a week or a month? So this is going to help give you an indication as to which expiration cycle you want to start working with. Okay. Okay, another trader suggested calls on Microsoft and Google, and again, this trader didn't say whether he was going to, and I don't remember if it was a he or she, was going to buy calls or sell calls. Didn't say. So, but here's my impression and my assumption is that this trader was interested in buying calls on Microsoft and Google right before they announced their earnings. And these are both companies that announced after the bell. These are after the market closes stocks. As far as I know, as far as I remember, they've never reported before the open, either one of these. And although Google, I remember a few years ago, I remember Google, do you guys remember that? When Google let the earnings release information out before the market closed? Oh my goodness, did that upset a lot of options traders, right? That were, oh my goodness, what a fiasco that was. Anyway, I digress. I want to encourage you folks who are interested in buying calls or buying puts right before the earnings, and then selling that said option the next day at the open or anytime the next day. You are exposing yourself to implied volatility crush in the worst possible set of circumstances. Go to the Option Slam webinars and go to February 22nd, 2022 webinar and view the webinar called Stop Buying Puts and Calls. Stop buying puts and calls at earnings events. All right. So anyway, let's take a look at that via let's see, Google. A bull on Google might think about, now I'll just give you a quick synopsis of this. I get rid of some of these trades. I just recently closed some trades on Google. Made a lot of money via the double eagle, by the way. Let's see, Google, add simulated trades. Let's see, if I were bullish on Google, I'm not going to buy a call. Let me, let's take a look over at Option Slam a quick minute. Give you the, let's take a look at Option Slam. Let's go to Google. Okay. And okay. There's other pages at Option Slam. Don't miss the implied move weekly page and the implied move monthly page. I usually go to those for whenever I'm analyzing any stock I want to go see what's going on. I want to see, first of all, I want to see right now at the implied move weekly page, what is the implied move for Google. Right now, the last implied move that we captured is 6.4%. That is the implied move weekly. And then the implied move monthly, if you want to look at the monthly options that expire the third week of Friday, that implied move is out to, is 8%. So you can see the bulk of that 8% is expected to happen this week. Okay, isn't it? The bulk of that 8% is going to happen this week, and then the remaining 2% happens over the next few weeks. Okay, so the action is in the front week weeklies for these through the earnings trades oftentimes. Does not mean that it doesn't. There's many reasons why you might want to choose the monthlies, but oftentimes we're going to be focusing on that. Now let's compare that implied move 6.4 to previous implied moves 6.4, 6.4, 5.8, 5.5, 5.6. Here's one that's higher. Here's one that's just slightly higher, and here's a couple others that are higher. Now notice all these that are higher are back to February of 23, so over a year ago. So in the last year and a half, this has been the high of the range, 6.4. So this is the high of the range for the last year and a half, and it wasn't until beyond that, further out in time, back in time, where the implied moves were slightly larger. We can scroll down. Oh, let's jump back to the earnings history page. I just want to see the EVR of this stock. Okay, the EVR of this stock has been down to a low of 1.6 here back in 2019, and now since then it's been climbing, and now it's back to 2.6. Now, so that's not it's not like Spotify. It's not a 4.7. It's a 2.6. It's fairly modest, and you can see the difference in the. Remember Spotify? 14%, 17%, 11%. A lot of big moves. Here, the biggest move we see is 11%. Okay, so that's why this is a much less volatile, but it's still going to experience implied volatility crush. So if you were to buy an option like a call or a put on this stock, even if the stock goes in your direction, let's say you buy a call and the stock goes up, what's the implied move? Oh, we got to go back to implied move weekly page. The implied move is like 6.4, if I remember right, 6.4. Actually, we don't have to go back. I forgot that at the top of each of these pages is the implied move, so you don't have to bounce back and forth. Some of that basic information is stagnant, or not. That's not the word I'm looking for, but it's static across all the pages. No matter what page you go to, this information up here is static. It's going to be there for you. So you don't have to jump back and forth unless you're looking for other more specifics and more detail. Anyway, 6.4%. So if the stock goes up 6.4%, and but the implied volatility crushes, let's go find a move that was about the same as let's see. Let's go to the implied move weekly. Let's do this. Here's how I'll illustrate this. Here was a implied move of let's find one where let's look at this. Oh shoot, my charts are out of whack here because of this split. I got to get this fixed. Oh boy. Every time I turn around, there's more work to do. Let me see. Let's see. Here's a move of, here's an implied move of 5.6%. And the stock moved, guess what? 5.7%. All right, let's go look at that. Oh boy, it's hard to think back. I'm going to go to think back, and I'm so frustrated with think back right now. July 25th after the close. Well, let's give it a try. July 25th after the close. I'm going to go to think back. think back, Google, I'm going to go July 25th of 2023. Let's see, let me make sure that I got that right. July 25th of 2023, yep. Was the earnings event July 25th of 2023 was the earnings event right there. Now, it's very frustrating because ThinkBack isn't working properly, so I have to adjust this date to the proper day. Let me, let's see. Shoot. Let's go to July 25th of 2023. Let's put on style, chart mode, data box, floating. Let's go check the price of this stock on July 25th of 2023. Okay. I'm in February. I need to go back to, let's see, November, August. I need a 2-year chart here. 2-year. Oh, shoot. July, here it is. July 25th of 2023. See that? It says right there, July. See the data box? It says the close was 122.21. All right. I'm sorry, I digress here. 122.21 is the close. Now, ThinkBack says the close was 121.53. That's wrong. 122.21 was the close of July 25th. Okay, so I have to force ThinkBack. ThinkBack is messed up right now. All of you Thinkorswim traders, all of you Schwab clients, call Schwab and give them hell, please. Tell them this is ridiculous that I can't use ThinkBack and I have to adjust the date in ThinkBack to be a different day than what to get the actual real options chain. Call them, everybody, call them, bombard them, and tell them how ridiculous this is. So anyway, here is it says July 26th here, but it's actually July 25th. So let's look at the front week weeklies on that day. This is Thinkorswim's back testing tool. And I could have done this at Option Slam. I should have just gone to Option Slam to find the actual real price. In our option OSBTT, our Option Slam back testing tool would have given me the real close. I wish we had more time. I could show that to you. So anyway, here's where the stock was trading July 1 year ago, basically exactly 1 year ago, July 25th. Now, if you were to buy a call, let's say you wanted to buy a call. Let's say you buy the At the Money 365 call. Okay, if you buy that 365 call back on July 25th, not the 6th, right before the earnings comes out, at the end of the day on the 25th, right before the earnings comes out after the close of Google, it would have cost you about $3.65 at the ask. Maybe you could have got it for the midpoint price of 360, which is what Thinkorswim is suggesting. And then if you would, and this stock actually, let's see, let's go back to Option Slam. What did the stock actually do? I can't remember. July 25th, this stock actually went up. It went up 6%, okay? It went up 6%. It went up 5.7%, slightly more than the implied move. And you bought that for $365 or $360, and you held that until the end of the next day. Well, let's move this date forward. Let's see, 26. Didn't quite prove the point that I wanted to prove. It shows a, let's see, 26. Whoops, not that. Oops, I did something wrong there. That's not what I intended to do. Oh yeah, I want one. Yeah, let's see, 28th, 27th, and then 26 is 0. Okay, so this is the 26th. Oh yeah, this is really the 25th. This is really the 25th. I can't, that's the thing, so frustrating. All right, so we go forward one day and the stock jumps up 6%. And so let's fast forward one day and you're up $372. So this is didn't illustrate the point of IB crush that like I had hoped that it would. But according to this, it says that you're up $372. We can prove that by going out one day and see if that 122 strike is now worth about would be probably about $7. And sure enough, there it is, $7. Okay, so that didn't illustrate the point that I wanted to illustrate as well as I was hoping that it would. But let's move on. Okay, stop by and put some calls. Okay, who else we had? Google, Tesla, Google. All right, let me check the chat box here. Time has gone by so fast. All right, so I missed some chats here. Should we not take the 260 strike since the expected move is 30? Well, John was asking about, I know that John was asking about the spot. Well, the thing is, be aware of your stock. Get familiar with your stock with the option slam historical data. Yes, I like to use I would have liked to use the 260 strike, and I did illustrate that at first, but then we looked at some historical data and I adjusted my strikes down so that I was more comfortable with what seems to be the worst case scenario, right, John? And then Bruce says, yes, IB crush has occurred. For spot, the 278 is the 3 standard deviation support. Really? 278? 3 standard deviations? I don't think that's 3 standard deviations, not the way I see it calculated. Let's go back there to that and see. Wayne, we were looking at spot. I usually have my standard deviation calculator set to 1 standard deviation. So if I go back to spot and I look to 1 standard deviation based on the front week weekly, right? And you see I got it set to 1 standard deviation right there. Now you can set it to 2 standard or 3 standard deviations. But, no, yeah, you're right. So that's the 1 standard deviation, okay? So that 278 that you're talking about, and now it's at 273, is 1 standard deviation, okay? The way I see it, Wayne, correct me if I'm wrong. Slightly bearish. Michael, you sent in, oh yeah, Michael, I forgot about that. I apologize, Michael. Now you've already made a ton of money on the UPS double eagle, right? So anything you do, you're just playing with the markets, you're playing with the market's money because you already got profits in your pocket. That's another thing that's cool about the double eagle is you can trade the double eagle and you're out before the earnings, and now you can trade a through the earnings trade with your profits. That's what's cool. That's another cool thing about it. I sent in a UPS slightly bearish 4%. Slightly bearish 4%. Let's look at it. UPS slightly bearish. Let me get rid of some of this stuff here and go into the options chain. Looking for a 4% move down. All right. Listen, 4% move down. I like it. 145 times minus 4% takes us 145 minus 4% takes me down to the 139. So here's a very simple, straightforward strategy. you've got, and thanks very much, Michael, for your suggestion. I apologize from the deepest, most sincerity that I forgot that you had emailed me. I don't know how I didn't get it into my PowerPoint slider reminders. Okay, 4% is saying, Michael is saying, I think the stock is going down maybe around 4%. The implied move at optionslam.com on UPS is, let's see what that is. And let's just take a quick look at, oh, I typed in implied move instead of UPS. July 23rd before the open. So tomorrow before the open, today's the last day to trade it. A lot of down reactions, and I kind of, patterns like this catch my eye. Down, 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 up 1 quarter, down, 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 up 1 quarter. It's like, come on, you guys, can't you have like 3 up quarters in a row? Why it's always got to be down? But patterns like this catch my eye. The implied move here is about 6%. So a 4% is a nice, modest, inside the implied move trade. I like the 4%. It's perfect for the setup that I'm thinking about. I'm going to look at a simple, pure, clean, straightforward, bare, vertical debit spread. Okay. I'm going to buy at the money, and I'm going to sell where I don't think the stock is going to go for beyond. So I'm going to control 139. So now what I'm doing is I'm buying a debit spread, okay, for $229. This is the amount of money at risk. Now, if you can redesign this any way you want, okay, but one example is you might say, well, I didn't really want to risk that much money, well, fine, buy the 146 instead. The 144 instead. Okay, now you're only risking 181. Okay, but now you're buying it out of the money rather than the at the money debit spread. Okay, and which one's going to have the bigger profit? Okay, so this one is risking 181 to make 319, and let's look at that 145 just for comparison. Now I'm risking 228 to make 372. So you need to do the math, do the ratio, see what your risk to reward ratio is, see which one you're more comfortable with. This one will not require as much of a move. Let's see, the break even on this one is at about 142.69. You see that? In this bubble that populates right here when I put my cursor above it, 142.72 approximately, versus the slightly cheaper one. Then the break even is at 142.13, a little bit further out of the money. So this more expensive trade, slightly more expensive trade, doesn't require as much of a move to start getting into expiration day profits. This is the blue line again, of course, is looking at expiration day, and then the purple line is the 1 day move. Implied volatility crush is a concern here, but not so bad. It's not like just buying the 145 call. So here's the rest of that discussion. I say stop buying calls and puts at earnings, because why? If I just buy the call, let me go back and just buy the call. What's the advantage to buying the call? Well, the advantage is, if I just buy the call, I uncheck vertical, the advantage is it's got unlimited potential for profits. If this stock just tanks, I can make thousands of dollars. You see that? $2,500 if the stock goes down to 115. What's the problem? Stock is not likely to go down to 115. It's very unlikely to go down to 115. In fact, the implied move is only 6%, And if you remember, the dated option slam suggests to you that it usually, let's go to implied move weekly, it usually goes down. When it goes down 6%, 8%, 3%, here's the biggest move on the table, 10%. It's a long cry from all the way down to 115. I didn't do the math, but that's a huge percentage amount all the way down here. It's just not going to happen. It isn't going to happen. I promise you. I can't guarantee you anything, but I certainly promise you. Promises were made to be broken, they say. So here's the problem with buying this put. Just buying the put. The problem is it costs $390. It costs double the spread, and I don't expect the stock to go past at least Wayne. Was it Wayne? No, it was Michael. No, oh boy, geez. Yeah, Michael said. Michael doesn't expect it to go much past 139. So why not sell the 139? That's one point. But the other point is, look at the Vega. Look at the Vega of this long put. It's 6 points of Vega. Means that for every point of implied volatility crush, that premium is going to lose $6. So if this volatility crushes from 68 down to 28 in the first day or two, that's a 40-point IB crush. That's 40 points. That's times 4, 40 points times, what was that, Vega? 6? $240 of Vega crush. This premium is going to crush to 2 if the stock goes nowhere. If the stock goes sideways, the IB is going to eat up $240 of this premium. This premium is going to be cut more than half. It's going to be cut by 60-some percent, 70% overnight from IB crush. But here's why I say, why not, if you don't expect the stock to go to the moon or to the floor in this case, down the toilet in this case, looking for a bearish move. If you don't expect it to go past 139, then why not sell the 139 and collect $150? Okay, why not collect $150 and put it against your debit of $380? So now you're only spending $227 at risk. You're not expecting the stock to go much further than that anyway. So do the debit spread and look at the Vega factor. Yes, it's still subject to some Vega crush, but not bad, because a vertical spread neutralizes some of these Greeks that are working against you in just buying options naked. Being long naked options at an earnings event just doesn't make sense. Unless you are expecting a huge move, that's the only time it makes sense. And if you're expecting a huge move, well, that's for another webinar. Here's another variation to this strategy. Instead of buying that debit spread, if you're expecting a down move, why not, let's see, where's the stock at? 145.26. Why not this? Here's one that will put Vega in your favor. Let's just do another very simple strategy. Let's sell a vertical, the 146. 141. Okay, I see what I did wrong. I bought it instead of selling it. I meant to sell it. What's going on here? I wanted to sell that one time. Sell the, let's see, so this is, I'm getting, there we go. There we go. That's what I meant to do. I don't know what I did wrong, but this is what I meant to do. Okay. Sell the call spread. And if the stock goes down, as you expect it to do, great. You have this $280 potential profit to risking a defined risk amount of about $218. All right, let's see. What else did I miss in the chat box here? Marco, both Microsoft and Google. Yes, I know, John. Yes, John says he noticed that wrong data back in November, and I did too. So I didn't notice it myself, but some people on my research team got switched to Schwab back last November, and I didn't get switched to Schwab until this May. So I didn't have to deal with the problem and personally in my own on my own computer, but people on my research team were having to deal with it, and I was having to deal with some of their work. And so I started complaining and so did my research team, all the way back in November. We've been complaining and calling Schwab and TD Ameritrade about that stupid thinkback problem since last November. I am so frustrated with this company. Schwab. TDA was great. TDA was no problem. But Schwab has just got me frustrated. If it wasn't for the Analyze tab, I might just say, you know what, forget Thinkorswim, I'm going somewhere else. But because I love the Analyze and I love their charting too, I'm trying to be patient and crossing my fingers and crossing my toes that they'll get this fixed. They would also list new option expiration series day late on Friday. Yeah, I know. I called Schwab at least 3 times. I've called them dozens of times. All I get is broken promises. Oh, I see, Wayne. Wayne was saying the 3 standard deviation was the 1-day move. With the 1-day move. Okay, I misunderstood, Wayne. Gotcha. All right, so let me clear that up with Wayne. Let's go back and let's go back and take a look at. I think that was that Spot. Yeah, I think that was Spot he was talking about. So what Wayne was saying was, rather than looking at the out to the end of the week, he adjusted his date to the 1-day move. So that would be the today being the 22nd, that would be the 23rd, and now the 3 standard deviation. Now things have changed since Wayne typed that, but at this moment, the 3 standard deviation from where the price is currently. This is all live and happens dynamically. When Wayne looked at it, it was at 278, if I remember the right number. Now it's at 268. Okay, so there you go, Wayne. Sorry about that confusion. All right, and all right, Michael, great. Michael's got a butterfly that he did on, must be Google. Is that Google? Michael? No, UPS, probably UPS. Let's take a look at Michael's UPS butterfly. Get rid of these. All right, now butterfly is a combination of both of those traits that I just had illustrated here. I had a debit vertical and a credit vertical. A butterfly is constructed using both of those strategies at the same time. So let's see, Michael's is the 145.40.35. Stock is trading at 145. So this must be bearish. So let's go into the fronts and let's buy a vertical. Let's do this the Let's buy the vertical, okay? We're going to build a butterfly here. This is how you build a butterfly. 145.40, use Michael's strikes, buy that vertical, okay? And then sell a vertical. So let's look at this first. This is the first half of a butterfly. The second half of a butterfly is now we bought this strike. Let me widen this out so these are easier to see. We bought this 145 strike and we sold this 140 strike, right? That's the first vertical. Now we're going to go ahead and we're going to sell a vertical. We're going to sell this 140 strike. So now we've got two of those short. You see, we've got one short from the buying this vertical. We got another one short from selling this. And then let's see his strikes again. 145.40, 35. Aha, skip strike fly. A skip strike fly, which also called a broken wing butterfly, I think, right? Let's see. 145.40. No. This is a regular fly. 35 with a bare 155, 50, 55 vertical calm. Oh, okay. All right. Upsold regular. Yeah. Okay. Yeah. Regular. Okay. Regular butterfly. So sell this 140. So now we're going to sell a vertical and then buy the 135. Okay. So control, buy that. So this creates the butterfly, and the butterfly is done for the difference between the debit and the credit. So it's $1.99. Now I can do it another way. Let me just do it another way, just to illustrate that. Let's buy a butterfly. Boom. And let's just adjust these strikes to be the exact same as those two verticals. The 145 40 35. Okay, so you can see $1.96 minus $1.11 is, guess what? 85 cents. These are both the same thing, right? If I look at this butterfly without the verticals, it looks like that. And if I look at these verticals together, guess what? They look exactly the same. It's the exact same trade. This is just the breakdown of it, okay? So there's that. But to pay for this, Michael throws in another twist. To pay for this, he's going to also throw in let's see, I believe a short credit spread on the call side. Sell the 150.55. So he's going out of the money to the 150. I love this. This is very creative. Analyze, sell that vertical, the 150.55. The only thing I'm going to suggest is that there is probably a so let me just put on this butterfly. I'm going to get rid of these two verticals. We don't need those on anymore. There's probably a ratio fly or a broken wing fly that could be done to create the same. Well, it wouldn't be quite the same, would it? It'd be a similar risk profile. I love this. This is really creative. I like this. The only thing I don't like about it is all the darn strikes involved here. And, it's a lot of strikes and therefore it's a lot of commissions. But I love the risk profile. I just love the risk profile. Putting this risk, let me change this out to the end of the week again. Rather than 1 day. And thanks, Wayne, for bringing that to the table, adjusting this day to the 1 day standard deviation instead of what I normally do is adjust out to the end of the week. How come it won't adjust for me here? 26, 27. There we go. All right, so there's the one, by the Friday of the end of the week, let me take this back to the 1 standard deviation, which is what I more typically like to work with. Because I don't usually close these trades the very next day. If they're working for me, I like to give them time. If they're working against me, I like to have the time to adjust them. Well, we're quite a bit over time here, but I'm glad I was able to find the time to get this presented and an opportunity for you to see Michael's creativity in creating this strategy. So look at the biggest profit. It's designed to hit the biggest profit right at about 1 standard deviation away from where the price is trading now. And if it overshoots, there is no loss. There's still a collection of about $29 net profit. If it goes the wrong direction, there's still profit available almost to 1 standard deviation out to the upside. Not quite, but it's a great thing. I love it. Very good. Thanks for sharing that with us, Michael. The rest of you, please, next week we're going to do the same thing. Send me emails in advance. Who was it? Someone suggested Netflix, the deep dive into technical analysis. I'm going to tell you right now, I'm not going to get too deep into the technical analysis. Everyone has their own sets of technical analysis tools that they use. And mine are going to be different than yours, are going to be different than the next guy. And I'm not going to say that mine are better than anybody else's. To each his own. You have to become your own trader. And I'm not here to teach in technical analysis necessarily. I'm here to provide insight into how options work, how strategies work, how you can design strategies so that you have decent risk to reward and higher probabilities of profit. Those are my focus, of course, all with learning about how to use Option Slam data to assist you and keep you safe, keep you on the right side of the market. So yeah, we can delve into a little bit of technical analysis stuff, but I'm not going to get into stochastics and RSI, MACD, et cetera, et cetera. You know, we can take a quick look, but it would be just a very cursory look. More so, I'm interested in your bias. Are you bullish? Are you bearish? Do you think the move is going to be very large bull move or very moderate bear move? And how long do you think it's going to take? Those are the critical components to design that we need to decide on before and as we are designing option strategy. Okay, everybody. Well, thanks for being here. Thanks for all your great comments and contributions to the webinar session today. Thanks for your patience and letting me go over time. And don't forget, check out doubleeagleworkshop.com. That offer to purchase the recordings from the last workshop is not going to be available very long. I have some time right now to help tutor some people individually and privately through the sessions, okay? And hold your hand as you're learning over the next 6 to 8 weeks. That's how long it takes, okay, to get through all the sessions. There's over 30 hours of training involved here. And I have some time to take on a few new students. And that offer will be going away. We will be raising the price. And the offer to get the recordings of the last session will, once we determine a date and put that out for purchase to register for the next workshop, which is undetermined when that's going to be, that's when things will change and the offer will go away at that point. So take advantage of the opportunity while it's still here. All right. All right. Okay, I guess that's about it. If I missed any of your questions, Yeah, okay. I'm just scrolling back. It looks like I got everybody's questions and comments, and it's like I might have missed one or two. I really apologize if I missed yours. If I did, shoot me an email and I'll try to answer by email. Or if I deem it appropriate, I'll answer in next week's webinar if I missed anything. And in the meantime, we're going to do this again next week. Next week, a week from today, same time, same place. Look forward to seeing you there. In the meantime, goodbye to everybody and wishing you all good trading.